Hello, this is Al Zmysłowski. I am doing the Introduction to Computerized Investing Financial Planning Workshop series. Next up is our legal disclaimer. This session is really aimed at educational purposes. We're not selling anything here. Uh, to a large degree, what you're seeing is personal opinion of the authors, myself and others. This is not trading advice. We certainly suggest that you will do your own due diligence, etc., etc., etc. So, what are we going to be doing tonight in terms of the agenda? Uh, so I found it fairly challenging when Fred asked me to take this on and do tonight's session because he wanted a survey session. He wanted introduction. He didn't want to go really in depth in any one area. And so tonight we're going to essentially kind of do a survey, maybe 15 minutes, max 30 minutes in any one area. So to some degree that's a good thing because you get an overview of many things. On the other hand, you may also be frustrated because you don't get a lot of detail. Certainly the local CIMI group or Computerized Investing group goes into a lot more detail on a lot of these subjects. So in terms of what we're actually going to be covering tonight, I'm going to do a brief introduction. First major topic will be some top investing websites based on surveys from AAII. Also from useful spreadsheets that will cover both Excel spreadsheets from the CI newsletter and also some spreadsheets that are Google Sheets. One thing next item we'll be talking about deals with library resources, Morningstar, S&P, and Value Line. Those are free resources. They're excellent resources. You can get them here at this library, and you can get them online, i.e. you can deal with them from home. Next major topic will be asset allocation and ETFs. That will be based on a freeware tool we'll be talking about. Since Robos tend to use a lot of ETFs and they're also a very popular subject, we'll have a few minutes on that. Next up, we'll deal with stock screening on how you do the analysis and implementation, and then we'll wrap up with some Q&A. Now, if we wrap up early enough, I do have some extra stuff I can get into. It will be posted online. And there are also some references that will be posted online, lots of links to interesting sites. Next up, introduction to the webinar and the FPW series overall. So there's Fred in the upper right-hand corner there, handsome devil that he is. This is particularly aimed at our web participants. Basically, what will be happening is at various points along the way, we'll be stopping and you'll see a slide for Q&A. We'll certainly take Q&A from the audience at any time, but if you have a question or a comment, you can please use your chat window to make those questions, and we have people in the back of the room that will at appropriate times kind of jump up and ask the question for you, so to speak, and so you should be able to hear the answer more or less in real time. There will be a recording made, I mentioned that earlier, for your reference, and that's really about it in terms of the overall workshop series. Topics covered in the FPW series already covered was fundamentals of investing and building a diversified portfolio. Tonight in November is this session, and then next session Fred will be back, and he will be talking about active versus passive investing strategies. That's an interesting topic. Fred tends to be a real more of a passive investor index type guy. I tend to be more of an active investor. So when we get into these discussions, sometimes we end up throwing things at one another. The next session should be, fairly interesting for you to see. Tonight's session, as I said, we've already gone over the high points of it, and uh, we'll just move on. Okay, uh, in this section, we'll be looking at top investing websites, as well as some useful spreadsheets. The idea here, or the goal, is to introduce you to a number of sites in various areas and let you try them out and explore them. Again, this is a survey course. It's not a PhD thesis. We can't afford the time and effort to, jump in detail with all these sites, but we'll do what we can. In terms of where this is coming from, the main resource is the CI newsletter Best of the Web series. There's also equivalent articles in the AAII journal. So I went through, and their survey has a couple of dozen websites. So I just went through and I featured my favorite websites and maybe a top runner-up. I did put priority on free sites, you don't have to spend any money to look at these sites. A number of these sites do have fees if you decide to go premium and buy their product. Sometimes that gets a little frustrating because you're over there, you ask for, you click on a link and it says, all right, only for subscribers. So, you have to decide on your own whether it's worth paying the money or not. Some of the winners in these categories as we go through, I actually use in a different area than what's recommended or what CI gave them a win for. I'll mention that as we go along. Obviously, there's plenty of other contenders out there. Uh, if you will, shout out if you have a contender that you want to have mentioned and such, and I'll tell you whether I know it or not. I mean, there's thousands of websites out there. I've seen, a fair number, but certainly nowhere near, I'm sure, even half of the ones that are out there. So away we go. The first one is Stockcharts.com. In terms of just getting charts out, this is probably one of my favorite sites. It is free, though you can get more capabilities for $50 a month. To give you some idea, they offer a number of free charts. They have a wonderful educational area. They have Chart School. They have an active blog, and so on. So it's really really quite good. Uh, their main claim to fame is they literally often offer dozens of technical indicators. Um, One of the things I use this for, you can set up ratios of one equity or one stock to another. So, for example, you can set up the SPY, which is the S&P 500, SPY, versus gold, GOD. You can set up a ratio chart and see whether SPY is trending higher than gold or whether SPY is trending less or going down, if you will, with respect to gold. That's important in terms of our equities outpacing gold. That may tell you something about an inflationary environment. It may tell you something about the amount of fear in the market. They also have uh, um, wide variety of technical indicators, simple moving averages, exponential, McClellan, MACDs. I mean, they have, as I said, literally dozens. And again, I'll point toward their um, chart school and their educational resources. There are many times when I don't, I'm unaware of a particular indicator or how it's supposed to be used. I go there and I can look it up and get a good answer really, really quickly. Next up, uh, Yahoo Finance. So here's one where uh, the CI newsletter gave them top winning status for company news. I certainly use Yahoo Finance for that, but I use them for so much more. I mean, that's one of my general websites I go to. It's got some pretty general charting capabilities, nowhere near as good as Stockcharts.com, but still good. You can, however I go there, you can get an overview of stock. They have a lot of fundamental data in terms of earnings and revenue and so on. One of the big things I probably use them for the most deals with, they have historical price data, so you can download mutual fund price data on a daily basis for literally decades in some cases. So if you're looking for that sort of information, that's there. And you can put in, they've got simple portfolio trackers. I mean, it is truly a very, very good site. So highly recommended for a number of things. Question? Um, the question deals with how do you download the data? There's a couple of ways. One is they have a historical data section where you can simply say, hey, you want to download the SPY for the last, since 1992 or whenever SPY came around. They have a simple link that you can say, yes, download it. It comes into a spreadsheet, no problem. There are a number of automated tools, including Excel, where you can download data from inside your spreadsheet. There are some freeware tools, some of which I use, that can download literally hundreds of stocks, ETFs, mutual funds at one time and essentially put the data in different tabs in your spreadsheet. I do that once a month because I run through a number of algorithms and I just download lots and lots of tickers. If you're interested in that sort of capability, email me and I'll send you the link. Okay, next up will be, let's see, Seeking Alpha. So again, they, CI gave them a win for conference calls and corporate events, and certainly they're very good that way. They provide, as they say here, transcripts of earnings, conference calls, major presentations. They occasionally have audio files of the actual conversation. Uh, you can get yourself on an alert list when they've posted those. But really, Seeking Alpha has so much more than just that. There's a number of analysts that blog on Seeking Alpha. I've followed many of those for years. There are some algorithms, some investing algorithms I've picked up from Seeking Alpha articles. There's just a ton of information out there. I'll give you one example. Uh, some time back, I was looking at MLP type investments, and I ran across a company called Terra Nitrogen, which is basically, they make fertilizer, right? I mean, it's not a very glorious business, not necessarily even very high tech. I'm a city boy. I didn't know much about fertilizer, so I was at Seeking Alpha. I found this analyst who did this amazing, I don't know, 5, 10 part series on essentially fertilizers and everything you ever wanted to know. I mean, from, you know, why you want to be near a railroad area, the, you know, the vital facts of why natural gas is so important, why China is such a strong giant inside the fertilizer industry, etc. I mean, I learned more about fertilizers and how you make them and what's good about them and so on than, quite frankly, I ever wanted to know. But you find people like this at Seeking Alpha in terms of, you know, they are very, very interested in one area and they blog on it and such, and it's a great resource. Now, as always, you know, you can't trust everything you see at Seeking Alpha. As you know, you can't trust everything that you see in most news sources and such, but it is a valuable resource. It certainly makes you know, it certainly makes it into my top 10. Okay, the next site is Zacks Investment Research. So Zacks is famous for their earnings analysis. Um, they again, as most sites, they have a free version and then a paid version that gets up to $250 a year. They're very well known, very trusted name. They've been out there for years and years. They have a number of investment algorithms that, you know, if you think it's that's good, okay, if you buy into their methodology. Uh, as you can see from the screen here, one of the key things they do are earnings estimates. They give you a lot of information about EPS, last quarter, surprises in EPS, EPSs for the current year, next year, etc. They'll, for example, give you the EPS and growth estimates for a company like Microsoft, and then they'll compare it to the Microsoft's industry, which I assume is software. They'll also talk about comparing it to the overall market. They have articles there. So, for example, well, in general, it's very important for companies to meet or beat their estimates. There's a lot of, if you will, management of estimates. To some degree, some companies are famous or infamous for you know, beating their estimates by a penny and such. There's also an unwritten rule that if you're going to miss your estimates, miss it big, i.e., you're going to get pounded anyway for missing your earnings, so throw everything in the kitchen sink in and have a, you know, if you're going to have a bad earnings report, have a bad earnings report, you know, and take the hit once. Basically, that's you know, the area that Zacks is famous for. Again, you know, this one is in my top 10 as well. Question? Okay, so the question is whether Zacks is available at the library. I can tell you that I don't believe they're available here at this library for free, the same way that, for example, Morningstar is available for free. Um, Again, a little later, we're going to be talking about, you know, how you can access at this library the Standard & Poor's sheets, Morningstar, Value Line. Unsure whether Zacks you know, any library has a you know, free access to Zacks. I'm not sure whether they do that. The only thing I can point you to is to look up your library, your local library, or the two or three that might be local to you, and look at their website and see whether that is in fact uh, available from them. They tend to have, I will say, Zacks tends to have a pretty good website. Uh, you know, that, like Morningstar and others, you know, reveal, you know, a fair amount of information, but certainly not everything. Okay, with that, next up, Market Watch. So this, again, this is one of these sites where CI won or gave them the win for economic news, and they're certainly good for that. MarketWatch has also got plenty of articles and blogs and such. So again, I've been receiving MarketWatch updates and newsletters for many, many years. So again, fairly highly ranked by me in terms of economic information. If you were to take a look at this, they've got a calendar, for example, of personal income and consumer spending and inflation and uh, supply managers, construction spending, etc., to give you some idea of what's going on in the economy. They've got a chart up here of payroll growth versus GDP growth. So it is a good economic site. I will put in a pitch for a magazine I read. It's called The Economist. It is not free. It's a magazine like Newsweek or Time or whatever. It has a subscription. Again, they have a website where they make some of their articles free. It's an interesting magazine for a couple of reasons. Basically, the first reason is it's sort of split between news and economics. The first part of the magazine, first half, if you will, deals with news from like a Time or a Newsweek or whatever, where you have news from the U.S. and other parts of the world and whatnot. And then the last half of the magazine is typically just everything about business, economics, etc., sort of along the line of a business week. The second reason I like The Economist is because it has it's a British magazine, so it gives a little bit of a foreign viewpoint on the world. They will say and reference things that are not common, for example, among the U.S. Magazines, and I think that's good. Certainly, again, you can get that magazine for free here at the library. They have a subscription. You can go read it all the time. Uh, if you get the paper subscription, you will get the digital version for free. Um, I wish they had a cut rate for the digital subscription only, right? Because I just take that. Um, okay. Uh, Next up. Okay, next, let's see. We're here at Reuters or Reuters. Uh, they got the win for fundamental stock data. Again, I would rank Yahoo also very highly, although Morningstar also comes in real high. To give you some idea of what they're talking about for fundamental stock data, if you come over here, you'll look and you'll see again numbers for company, industry, and sector. So they give you that comparison. Just going down a few of the stats here, sales most recent quarter versus a year ago, sales trailing 12 months versus a year ago, sales 5-year growth rate, same sort of stats for EPS, capital spending, etc. So they'll give you all the numbers. They also do a very good number in terms of ratios. If you're familiar with quick ratio and current ratio and all that sort of thing. So again, it's a good site. I have to admit this probably doesn't make it into my top 10 because I tend to use Yahoo so much. Okay, let's see. Coming up next is ETF.com. Now this is interesting because they won for mutual fund and ETF ratings and recommendations. Well, ETF.com just follows ETFs, not mutual funds. I have to admit, we've had the CEO of ETF.com come down and speak at one of our events in the chapter. Very, very knowledgeable. They go into an amazing amount of information on their website in terms of how the ETF is structured, whether it's a good fit, how tradable it is, all sorts of things. They've got a good screener where you can compare ETF-A versus ETF-B. Very, very, very good. And as mentioned down here, there's a lot of this information can be downloaded into Excel, which helps you again if you're trying to do some analysis outside of ETF.com. Let's see, next site. Oh, here we are. Yep. Okay. Portfolio 123. So, excuse me. Um, this is in fact, the only paid site that I have here today. The reason for that is later on in the presentation, I'm going to be using Portfolio 123 as both a stock screener and as a back tester. So I thought I would introduce it here. It won for stock screening. Certainly another great tool that is out there and available is Aaii Stock Investor Pro, also known as SI Pro. It's also another very good screening tool. If I remember right, SI Pro runs about $195 a year. You can see here that this runs from Portfolio 123 runs from about $350 up to $2,400 a year, so it can get pricey. I have kind of a middling version of this, so I'm also grandfathered in from a tool that used to be called StockScreen 123, but that's a whole nother set of discussions. They have a very good library of fundamental screening techniques, etc. I can tell you that a variety of universities use this tool in their MBA classes. Very good tool. Now, for those of you who don't know about stock screening, what you're trying to do with stock screening is take a universe of, there's probably 7,000 stocks that can be traded in the U.S., something like that, and you're trying to say, okay, well, I want stocks with very specific characteristics. So I want all the stocks with a market cap above 1 billion or 10 billion or 20 billion. I want to look at stocks that only have low PE ratios. I only want to look at stocks that have small market capitalizations below $1 billion. I want to look at momentum stocks and so on. You can combine these things that you're looking for, and they give you a set of stocks that will tell you what you want to do, or that are good candidates that meet those screening variables. So it's one way of finding stocks. That is not, there are people who are technical analysts or chartists that look for stocks via price patterns and so on. This can do a little bit of that, but it tends to do more in the way of fundamental analysis. Now, the reason I picked Portfolio 123 over Stock Investor Pro is that Portfolio 123 can do back testing, i.e. it can go back through time and basically say, hey, what could you have bought at what point in time, and give you an idea of how your algorithm works over time. There is not a back testing capability built into Stock Investor Pro, and so that's one of the reasons I prefer Portfolio 123 over Stock Investor Pro. Okay, let's see. Next up, this is the Q&A session. Sounds like there may be a question here coming up. Let me just quickly say that there's a lot more sites, and on the online version of the file, when it gets posted, you'll see that there are more at the back, after in the reference section after the formal end of the session. You'll see some more top websites. If we have some time tonight, we'll also take a look at some of those. So that question. Sorry, it's a little weird. I've got this boom microphone around my ear, and it sometimes gets in my way. So I don't know the particular website that you're referring to, so I don't have any opinion on it. I do know a site called Portfolio Monkey that is pretty good. I've used it, but I'm not familiar with the website you mentioned. If there's no more questions, next up, spreadsheets. Um, let's see. Uh, so the goal here with spreadsheets is to introduce you to the type of work that can be done with spreadsheets. I am not going to, bore you to death with going through lots and lots of cell equations or Excel equations in terms of what's inside each and every one of the spreadsheets. I've done that before, and any number of people have gone to sleep on me. Um, the main resources for this area are this is Computerized Investing has a spreadsheet area where they do an article on a spreadsheet, and then they have a link to where you can download it. The second major source is the chapter ran back in 2011. The chapter ran an Excel class. That's still up. The homework and information from that class is still up. It's at Yahoo. If anyone's really interested in getting into the nitty gritty of spreadsheets, I am more than happy to provide them a link to that. Um, so before I go too much further, how many people here are familiar with spreadsheets? Okay, so most of you. Okay, very good. I thought spreadsheets are pretty common, so I thought most people would know. Uh, there are also two read-only Google Sheets that we'll be going over. That one implements a simple stock tracker, another one implements a mutual fund watch list. We'll be talking about that as well. If anyone needs any of these spreadsheets, uh, let me know and I'll send you a link to the article or whatever so that you can read it. And then we'll essentially end up, if you have questions on the spreadsheet at that point, I will, we can do a Q&A offline. Okay, and away we go. Okay, so there's basically three different groupings of spreadsheets we're going to be talking about. The first deals with calculators that are available. Then there's some fundamental spreadsheets. And then there's, if you will, some technical analysis spreadsheets. Starting off with the ones up top, the calculators, if you will. Um, the mortgage refinance is a simple worksheet that talks to you about what happens if you do your redo your refinance your mortgage, how that could affect your cash flow. The retirement withdrawal calculator essentially is exactly that. We're going to be talking about a more sophisticated way to model retirement withdrawal calculators, but this one lets you put in a few estimates to see whether you're going to have enough savings. There are a variety of other calculators at CI. The main reason uh, to use these calculators versus some of the many calculators that are online is basically the calculators that are online. They're set for the most part. If you wanted to do something special, put in numbers that they don't support, you effectively have to live within the restriction of what's online. Here you'll be able to see what the calculator does, and if you want to implement your own rules or try out some cases that are kind of strange, you can modify the spreadsheet accordingly and do your own calculation. So that's the main reason to use these types of calculators. Now, next up, financial ratio spreadsheets. Um, what the first one does is it tries to go to, well, we've talked about Morningstar and a couple of other sites where you can go to and get fundamental data. This spreadsheet imports that and then comes up with various ratios and such. Um, by the way, just by hands here, how many people here are fundamentalists and tear apart uh, accounting statements and annual reports and so on? Okay, I can see there's thousands of you who do that. Okay, so I'll treat it pretty lightly then. Um, the next spreadsheet here deals with return on equity. So to give you some idea, equity is to some degree what the stockholders of the company own. That's what you own of the company. And return on equity is returned on what the stockholders own. So for example, if you own $100 of stock, okay, and the return or the profit is $2, well, you're making a 2% return on equity. If you have $10 of earnings, you're making a 10% gain on that $100 worth of stock. So this gets into things like profit margins, both gross and net, inventory turnaround time. It's a bad thing in general to have inventory. In a perfect world, no company that has inventory, we'd all like to have zero at the end of the day because inventory just sits there not doing anything for you. You want to sell it, right? Now that's impossible, but in terms of quickly turning over your inventory or selling and getting rid of your inventory to the customer, that's very important. Um, so basically that gives an idea of what return on equity does. These, again, because not very many people do this sort of analysis, this is what these three spreadsheets do. If you're interested in doing fundamental analysis, boy, this is a great area. Now the green area deals with, as I said, technical analysis. The first one here with the Ulcer Index on the AA stock screens. First off, what is the Ulcer Index? It is what it sounds like it is. Stocks can cause you ulcers, right? I mean, if they go down a lot and they bounce around a lot and so on, that causes an ulcer. Um, so take the example of when a stock goes up. If every month when you take a look at your brokerage statement, goes from 10,000 to 15 to 20 to 25,000, you're very happy. There's no ulcer. The ulcers are caused by when you're at $20,000, that stock is at $20,000, and now it goes down to effectively $18,000. So it has a 10% hit, if you will. Um, if it goes down and then it goes back up to 20 or maybe up to 22, it's not that bad. Okay, you had 1 month worth of ulcer medicine that you had to take. On the other hand, if it goes from 20 to 18 to 16, etc., and it goes down and stays down for a long time and doesn't hit 20K again for a while, boy, that your ulcer is really growing. So there's a way to mathematically calculate all this, and that's effectively what the ulcer index is. And this um, Excel spreadsheet goes ahead and does that. Again, ulcer index is well known among financial professionals and traders and so on. Um, give you a kind of an idea if the SPY, which is the S&P 500, and the IWM, which is basically the small cap 2000. Uh, Basically, the SPY is going to have a better ulcer index. The IWM over long periods of time, because they're small caps and they're growing, will probably beat the S&P 500 in terms of growth, but it's got a very rough equity curve, or there's a lot of volatility in terms of getting that extra gain, and therefore the IWM will have a higher ulcer index than the SPY would. Uh, Okay, next up is a spreadsheet to construct moving averages. By show of hands, how many people know about moving averages on stocks? Okay, so most people. Okay, so from this spreadsheet, you can not only create a moving average, you can also um, generate multiple moving averages and do what is called a moving average crossover system. Um, how many people are familiar with moving average crossover? About a third of you. Um, okay, so um, basically a moving average crossover is when you have typically a fast moving average, let's say 50-day moving average, and it crosses over a slow moving average or a longer moving average, let's say like the 200-day moving average. Um, so the idea is if when the fast moving average or the short moving average crosses over above the long moving average, that's a good sign because that shows that um, that the stock is trending up above its long-term average, and when it goes below, that's bad. And so when you cross going up, you buy the stock. When you cross going down, you sell the stock. Now I used 50-day and 200-day there on purpose. Those are famous averages that are well known in the market. When the 50 crosses above the 200, because you should be making money, that's known as the golden cross. When the 50 crosses below the 200-day moving average, that's known as the death cross because you're going to lose money. So there's these really sexy type names uh, for that. Um, basically, you can figure those out. You can change them, to I want a 48-day moving average, not a 50-day moving average, et cetera, et cetera. Now, there's many more spreadsheets at the site, and I mean they deal a lot with bond duration, bond convexity, etc., all sorts of things. So also I will mention that if there's enough interest in the above, the chapter is willing to consider another Excel class where we could walk through these spreadsheets. Again, it does get down to looking at cell equations and what does this equation do and so on. So it's not necessarily the most exciting way to spend an evening, but we'd be willing to uh, rerun the class if there's enough interest. Okay, question. Okay, so the question is, there's lots of articles in the CI newsletter and so on, but it's hard to find the download area. You're right, the download area is not well shown. Best you can go is they have a tab or a link that says spreadsheet area, and that gives you a list of articles. And then you have to go to if you're interested in um, a particular article slash spreadsheet, you click on that article, you go to the bottom of the article, and at the bottom of the article is a link where you can download the spreadsheet. So it's a little bit painful. I know a lot of other sites just have a download area where you go there and there's they just have links to download everything basically in one page. Here you have to do a little bit more work. Um, why don't you try that out? If you have any problems with what I'm describing, just send me an email on the article or spreadsheet that you're interested in, and I'll be happy to work with you. Another question. Okay, so the question is, do you need to be a member of AAII to get the CI newsletter? Uh, the quick answer is no, but you get a discount if you are a member of AAII. So, for example, I think an annual subscription to AAII is $29 for a year. I think you can get a trial version of or trial membership for 30 days for free. I know some people have used that before to go ahead and download articles, and besides getting an idea of what the site looks like and what the articles are and so on. I know some people have downloaded articles and done things during that 30-day period. Typical actions for a free trial period, right? But again, for 29 bucks a year or whatever, I don't know if it's worth it to play those sort of games. This is from memory, so it could be wrong. But I think CI by itself is $49 a year, the CI newsletter. And I think if you're a AA member, it's $29 a year. Um, to check those, just go to the website and check out the numbers. I mean, they're not triple digit subscriptions or whatever. They're relatively inexpensive, and that quite frankly is whole purpose of where again, AAI is a nonprofit institution. They're not trying to make money off of this stuff. Um, okay. Uh, okay. Another question. Samples of the spreadsheet. Um, so what I'll do and I'll make this offer to anybody, if uh, if you can't get the spreadsheet that you're interested in, either from this list or the article list or whatever, just write me an email. You've got that at the front of the um section here, or the front of the presentation, and I'll work with you to get you the spreadsheet. Now, to be fair, I don't want to be handing out hundreds of spreadsheets or lots of copies of these spreadsheets. The intent here is to give you a flavor, and if you've got one or two that you're interested in, great. If you find them that valuable, you probably really want to become a member of CI. Okay. Okay, so um, 2011 Excel class. So again, this refers to the fact that back in 2011 at the Saratoga Library, the chapter ran a 4 or 5 week set of classes, part of which were the Excel class that I'm about to talk to you here about. Um, we really did get into the nitty gritty of the spreadsheets in that class. I'll walk through the various classes of what we did. We started off in class one with really the basics. So, for example, how do you download data from Yahoo into a spreadsheet? You can do that manually or with a freeware utility we provided. Assuming that you download the data, the first question you're going to have is if you're comparing two equity curves and two price curves. For example, the SPY for the S&P 500 and the MDY for the mid cap stocks. How do you normalize the data? Meaning, how do you compare them directly? They've got different price values, etc. So we talk about doing that. We talk about how once you've got an equity curve, how you can go out there, how you can chart that. Uh, and then we get into some of the simple statistics that Fred has talked about in previous sessions. So you'll see compound rate of return, that's CRR, that's sometimes referred to as compound annual growth rate. Then you get into drawdown and max drawdown. One question before I go too much further. How many people here know what drawdown is and such? Okay, so we have about 2 or 3 people. So I'll describe drawdown a little bit. Um, I'll relate it to a brokerage statement. So let's suppose you're in a bull market and you open up your brokerage statement every month and you go from 10,000 to 11,000 to 18,000 to 20,000 over a period of months. You're very happy. You're going monotonically up, increasing every month. Life is good. Now what happens is you go from 20K down to 18K. The market drops a bit. That would be a 10% drop. That drop from your last peak value is called drawdown. Now, if what happens from there is you go from 18K to 20K and 22K and you continue to increase, life is good. Okay, you're making money. Excuse me. Now, the issue comes up with, well, what happens if you went in a bear market and you were at 20K and then you're at 18K and then you're at 16K and you're at 14K. Suddenly you've lost 30% of the money you had at the peak. And then let's suppose it turns around and you start making money again. That the biggest drawdown that you've seen is what's referred to as maximum drawdown, or MDD. Okay. All this talk about drawdown is very important because in reality this is what causes people to sell. Lots of psychological studies have shown that it's much more, you get a lot more pain per dollar loss than you get happiness per dollar gained. We're risk averse. And so you get a buy and holder type person. They're buy and hold. They've read all the books. They're in there for the long term, and they lose 5%. No problem. That's normal market fluctuation. 10%, normal market fluctuation. 15%, that's kind of large. 20%, hey, what's going on? 30%. Geez, I can't stomach this. I got to leave the party. This is what, and people sell. And this is typically why individual investors in particular, sell low and buy high. They hang on for, if you will, a while, but it gets too painful for them and then they exit. Now the problem here is that your typical bear market drops, you have a max drawdown, if you will, in a bear market of about 25 to 30%. And that's beyond the pain threshold of most individual investors. And that's why so many people tend to get out of the market and take a loss at the end or at the depths of a bear market. And then they don't get back in because they've been burned. They don't get back in until the market has recovered quite a lot. So that's where the phrase of sell low and buy high comes from. So, interesting story. I used to have an old finance professor over at SCU. He was a true efficient market hypothesis type guy. He strongly believed that over your lifetime you just couldn't beat the markets. And he had a very interesting investment philosophy. He looked at his statements once per year. Okay. And, he had a mix of stock and bonds, very simple. Basically his viewpoint was he looked at it once per year, simply to rebalance to some degree if things have gotten out of whack, and then he went on his merry way. He believed that virtually everything else that you hear, CNBC, all the talking heads, etc., is just so much noise, and you shouldn't pay a bit of attention to it. And he did very well over the years. Okay. In fact, you can, in a little while, we'll be taking a look at something very close to what he did. And you'll see that it's a good strategy. So spent a lot of time on Class 1. Class 2 in this series talks about forming simple moving averages. Talks about, for example, we've talked about the Golden Cross and the Death Cross and such. Excuse me. How could you do that? And now one of the things, if you are going to time or do volatility control, the question always comes up of, okay, well, the market's going down, but what do I switch into? Do I go to cash and just completely end the get out? Do I go to a low volatility a set of stocks? Do I go to a general bond fund? Do I go to long duration bonds? Do you go to gold? I know some people who do that, etc. And so this class talked about, how to do that, whatever your choice is for where you end up when you get timed out. It shows you how to do that in terms of the spreadsheet. The next item deals with, or the next class rather, deals with ETF ratios and the fund X score. So by ETF ratios, again, I really mean asset class ratios. And so it shows you how you can compute those in a spreadsheet. They're pretty easy. So for example, a relatively famous one is a SPY gold ratio, where you take the price of the SPY divided by the price of gold, and you get a curve. And when it's going up, that means SPY is beating gold, and when it's going down, it means gold is beating SPY in terms of price increases. You can apply a simple moving average to that ratio, and there are some very simple strategy systems that will tell you should you be long SPY or long gold. So we go into that. The other thing that we talked about in that class is a very famous momentum scoring system. It's called FundX. It originally comes from a newsletter that started in the 80s called the No Load Fund X newsletter. Since then, that newsletter still exists today. It's an electronic form. Back in the day, I used to get it in paper, I think once a month, if I remember correctly. And all the FundX score is, it's ridiculously simple. You take if you've got an ETF, let's say the SPY, S&P 500, you can compute that FundX score is 1 month gain plus 3 month gain plus 6 month gain plus 12 month gain. You add that all together. You take the average, which means you divide by 4, and that's your FundX score. Now they throw a few more things in there, but basically that's the FundX score. You can go through and do that, and in fact they do it for literally hundreds of mutual funds, for ETFs, etc. And what this gives you is an indication of which funds are strongest in the market. So for example, if you were going to do this on the 9 sector funds that are available, you compute the FundX score on them, and then you may decide, well, I'm going to be in the number 1 sector fund by FundX score, the number 1 and 2, 1 and 3, and that gives you some idea of, you'll be following the sectors that are hottest or have the most momentum in the market. So we go through and we show you how you can do that in class 3 to come up with all these scoring systems. Class 4 really gets into what I was talking about before, which is how do you combine multiple assets and rebalance between assets. We use the Faber 5 portfolio, and that's a portfolio that looks at 5 asset classes: U.S. stocks, foreign stocks, U.S. bonds, commodities, and U.S. real estate. There are variations on that where you can pump that up to 10 classes, but the base algorithm is, again, just 5. And again, Meb Faber wrote a book about this called the Ivy Portfolio back in about a decade ago at this point. And again, you can rank these with the FundX score. You can decide, hey, I want to be in the top 2 out of these 5 assets. So you can do many things, and class 4 shows you how to combine asset classes in the way I'm describing, and you can excuse me, you can time each asset class and or score, use FundX to score so you can be in the top asset classes. So again, all these classes and the spreadsheets associated with them are in a Yahoo group. I'm perfectly happy to pass that Yahoo group link along so everybody has the capability of going back and taking a look at it. And that's about it for this one. Let me go on to the next slide here. Oh, question. Got to go backwards. Okay. Okay, so the question again is where are the classes located? They are, again, as I said, they're online. Uh, the classes include homework. At the time, I was a very nasty lecturer giving people homework over the week. If you're interested in this, email me. I'll send you the link to the Yahoo class. There's a board, there's some posting discussions, etc. And as I mentioned at the bottom of the slide, if there's enough interest in rerunning in this class, the chapter's willing to try and rerun it. Again, you have to understand this is an hour to 2 hours of me walking through a spreadsheet and talking about cell equations. So it's just absolutely thrilling. Okay, there's no better way to spend an evening than listening to me talk about this stuff. Okay, so with that, we'll go to the next slide. Yes, Google Sheets. So how many are familiar with Google Sheets? Okay, a few. So basically, Google, to provide a base explanation, Google provides a number of Office-like capabilities at their site. So they've got a Word-like program, etc. Their Excel or spreadsheet equivalent is called Sheets. And you can go there and they provide a pretty good, basic set of spreadsheet capabilities, and you develop your spreadsheets, put in your data, what have you, and you can create and store them, your spreadsheets there. So it's free, which is of course a really positive thing. So a lot of people use it. You can also share these spreadsheets easily among people. So in this particular case, we have a spreadsheet here. It was originally built by Jacqueline McClellan, the current editor of the Computerized Investing newsletter. It is a read-only sheet, meaning you have to be a member of CI to, if you will, enable the sheet so you can put in data. I provide a link to the sheet there so you can find it, if you will. You can read all the equations from the sheet, so there's no problem there. It's just that the link I will provide you, you can't update anything in it, again, unless you contact CI and they give you the magic password, if you will. So what happens here is this yellow or orange or brown area here. This is where you input your data. This, again, is a portfolio tracker, so the idea is you have a number of stocks or ETFs or whatever, and it will essentially, you put in the base information, and it will track them on a daily basis. What that means is there are actually calls within the spreadsheets to Google Finance, and they will give you, Google Finance will give you a variety of information like the price of the stock or the ETF. So for example, in this case, you have to put in the tickers. The spreadsheet has tickers like Gilead, Microsoft, Micron, etc. There is a purchase date. Again, you're going to have to put that in from your portfolio records. There's commission you paid. In this case, it's $7. That sounds like Fidelity. Purchase price, and their shares purchased. Okay, so that's all the information you have to put in from your brokered statements, if you will. And then what Google does is it tells you the date. It figures out the name of the stock. Tells you what their total cost was, average cost per share, what the current market value is, what the current price is, the open, the intraday high-low, the volume, the 52-week high-low, the price-earnings ratio, the earnings per share, and how much it changed percentage base on a percentage basis today. So it gives you a nice little way to track your portfolio in real time. There are plenty of sites out there on the web that can do the same. Yahoo's got a very basic portfolio tracker, etc. So there are competitors to this. However, you can, again, the power of all spreadsheets is you can customize things to whatever degree you want. So, for example, if you want to know how far away today's price is from the 52-week high or the 52-week low, you can compute that if for some reason that's important to you. So that's that's the basic capabilities of the spreadsheet. I guess that's about it. Yeah. Next up. This is the second Google Sheet. This is a mutual fund watcher. Again, it was created by Jacqueline. Again, you have the link. Again, it's read-only. Again, this pulls data directly from Google Finance. In this particular case, you only have one area where you have to enter in information, and that's just the ticker of the mutual fund. And so, for example, some of the tickers here are VFINX, which is the Vanguard 500 index funds. That's been around a long time, I think since the 70s. They've got the Dreyfus Mid Cap Index Fund. They've got the Vanguard Small Cap Index Fund, etc., etc. Now, what happens here is you put in your ticker, and you get the company name, the price, the close yesterday, the NAV value, the one-day total return, 4-week total return, return year-to-date, annual return, 3-year return, 5-year return, yield, distribution yield, expense ratio, and they actually give you the Morningstar rating in terms of 1 through 5 stars. So again, it gives you an idea if you're trying to track or watch. In this case, it's a watch list. If you're trying to watch when you should be buying various mutual funds, this automates that process. Oh, question. So the question is, does this make sense to use with ETFs? As far as I can tell, the answer is yes. The one questionable field is NAV dates. I don't know what Google will come up with for a NAV date. I don't think there's a NAV per se for ETFs. Other than that, the other thing I can think of, I'm not sure whether what will happen with Morningstar ratings. I just don't know what will happen. So again, underneath the covers here, you've got Google. You're talking to a Google API when you make you'll make a call, a spreadsheet cell equation that will say, hey, in some format that says, give me the price of ETF X. That's available. And in some of these calls to Google Finance, I'm not sure what will come back with them. Question. Okay. So let me be clear about who does what here. So Google gives you the tools, the API, the cell equations to grab data from Google Finance, like the price, for example. Okay. Now, Jacqueline McClellan, or you, if you get into this, Jacqueline created this spreadsheet. Okay, so she put it together to show, hey, this is the sort of thing you can do with Google Sheets. So that's the difference. Google Finance in passing is it's another site that I use. Admittedly, not near as often as I use Yahoo Finance, but it does have some advantages. You're seeing one of them here. It is a good website to visit. They do have a variety of capabilities. So, that's another one to put on your list, if you will. Question. So what's NAV? NAV stands for net asset value. What's happening and what that really means is mutual funds hold a number of stocks, typically if it's a U.S. stock fund, and each one of those each one of those stocks inside the mutual fund has a price. Theoretically, yeah, you should add up the number of shares times the price of each share and of each stock, and that should be essentially the price of the mutual fund. Uh, that's net asset value. From time to time, the price of the mutual fund may wander a bit away from that. And that's why people look for NAVs for open-ended mutual funds and ETFs. That usually doesn't happen to any large degree because there are forces in the market to keep that difference down. Uh, there's an equity type called a closed-end fund where the NAV and the price of the closed-end fund can actually differ significantly. And there are whole trading strategies about when you should buy closed-end funds based on that NAV price. Okay, so one other Google-related item. Google has a page on their website where it will go through and it'll tell you all the spreadsheet commands that you can use to access Google Finance data. Some of them are here, buried in the spreadsheet, so that's a good thing. However, there is a pointer to that area that you can go and view it yourself and see all the capabilities they give you. Another item that I will mention is with the use of Google freeware tools. If you look at the license agreement they have you sign off on, i.e. click and say, yes, I agree, they own all the data that you give them, meaning if you put in your portfolio and if you use a Word document and you're write a letter or whatever, if even your emails that you give with Google, all of those, you have essentially agreed that Google owns that data. Google basically agrees that they're not going to share that data. They're not going to give it out publicly. However, they can use it for their own internal purposes. So a lot of people don't know that. They don't, Google is not doing this out of the kindness of their heart. They're doing it because they get some value from you putting in your information. Okay, I'm not saying that's bad. I'm not saying that's good. I'm simply saying that, in fact, you have signed up for that when you use Google Sheets, for example. Okay, next item. Questions. So this gentleman has, I'll call it a comment. It's really not a question. Basically, he's stating that you can take a Google Sheet and you can copy the cells and paste them elsewhere, i.e. to a new sheet. And in fact, you can copy an entire sheet and put it on a new sheet. And that would, for example, make it very easy to reuse some of these spreadsheets that I'm talking about. So thank you very much for that comment, sir. Okay, doesn't appear to be any more questions. And so moving on to library resources, Morningstar, S&P, and Value Line. Okay, so what do I want to get done here in this section? I basically want to tell you how to get to these services, those three investment services here at the library. You can get to them remotely, i.e. from your home. I want to provide a very brief overview on what these tools can do for you. They're in many ways very good tools. I have used all of them. Uh, However, each to do a reasonable overview of each of these tools would take a couple hours each. We're not going to do that. I can only really tonight point out, the major items of, uh, of each one of these tools, and then thankfully, because they're free, you can go out and look at them yourself. Now, most of these sites and the major resources here being used, besides the library web page, are the service providers themselves. Uh, Morningstar in particular gives away a lot of free information, meaning they have a free version of their site and then they have a premium version that you pay for. There's lots of good stuff on the Morningstar site. So S&P is, not near as good in my opinion as Morningstar, but they do have some information. Value Line is truly an investment advisory service, i.e. buy this stock, sell that stock, that sort of thing. And so other than explaining the basics of what they do, they don't have a lot of free information on their site. They expect you to write the check and buy their product, which is fine. Um, okay, so with that, away we go. So how do you get to these um, resources? I've provided a link up here in the top. I just go to the research capabilities listed for the library. Amazingly enough, I go to M for Morningstar, and this sheet here, this site here, this page pops up. And what you're looking to use is the Morningstar Investment Research Center. And if you click on that link, what you'll end up doing is going to the login page. So yes, indeed, you need to have a library card to access this. And once you get that library card, it's free, by the way. Uh, you put in your username, you get a PIN code, you log in, and then boom, you get to the Morningstar tool. So one thing that I will put in a plug for the Santa Clara County library system. They have very good resources for a public library. Morningstar sells this product to libraries and public libraries and academic libraries. Academic libraries being Stanford, Berkeley, those sort of folks. Uh, so Santa Clara County has done a really good job of providing resources to you. Now, other library systems, Sunnyvale, San Jose, will each have their capabilities based on what they decide uh, is a good thing and how much money they have and such. So you will have to visit their web pages for your particular library to find out what is available. Okay, let's see. Slide 28. Uh, I've already talked about the fact that there is a difference between academic libraries and so on. Um, and effectively, this gives an idea of what the product itself provides. And so I'll just move right along to the basic capabilities, the practical functionality. So walking through this, you have some screening tools available to you for stocks, funds, and ETFs. So again, screeners are something like I want to see all stocks with a market cap of $1 billion. So you can put that command, if you will, into a stock screener, and you can see everything that pops up above a billion. So you can do it yourself. There are also preset Morningstar screens that people use. Morningstar, if you will, has thought through the whole process and said, yes, uh, this is a good screen, and they just make that available. They have a portfolio X-ray feature that you essentially put in your portfolio, and Morningstar will tell you things about it. Things being along the line of market cap, what percentage of your portfolio is in large cap, mid cap, small cap, part of your portfolio is U.S. stocks, foreign stocks, what sectors you were involved in, etc. The item that most people use for Morningstar's analyst reports, they're famous for that, so you can jump in there and get that information. And they also provide information on market data, meaning the market overall, sectors, indices, industries, etc. Now, one comment I will make here is that some brokerages may have or may provide you Morningstar reports as part of their service to you as a brokerage. That's also true for S&P. So depending what brokerage you're in, you may have access to some portion of these capabilities in that way. Question? Okay, so the question is, what is X-ray capability? So again, based on information that Morningstar knows about the funds, and funds are, as with stocks and a variety of other financial instruments, are required to on a quarterly basis, report a wide variety of information to the SEC, the Security and Exchange Commission. So that makes all this data available to Morningstar, and then from there, Morningstar can provide you knows the information about the market cap of Fund A, the sectors that Fund B are in, etc., and they can do the analysis that I mentioned earlier in terms of looking at your overall portfolio. While we're on this topic, I guess I'll mention that many people buy funds that are essentially the same thing. There's a lot of fund overlap. Many times, people don't see this until or understand this until you get an X-ray type capability that tells you what each fund contributes, if you will. I think there's been a bit of a study in the past that said effectively once you get above a relatively small number of funds, I'm going to say a dozen, might be lower than that, you've effectively bought the S&P 500. You're just spending a lot more money to do it. There are exceptions to that rule, by the way, of what I just said. If you're buying funds that specifically are targeted to segments of the S&P 500, for example, a sector fund, you avoid that problem. But if you just go out there and, if you will, throw darts at a dozen mutual funds, you're probably going to end up with the equivalent of a broad-based index. Another question? A question is, can you upload funds and your portfolio into the X-ray capability? And I flat out don't know. Okay, I just don't know. Sorry. Okay, next slide. Excuse me. More capabilities. They have Morningstar offers all sorts of articles and videos So there's no problem there whatsoever. Some of these videos, by the way, are at Morningstar's site. Some of the videos are on YouTube. Uh, However, again, a good part of the content is behind their paywall for the premium version of their product. Articles and newsletters, yes. Help and education. Uh, and tutorials, an investing classroom. That is really great. They spend a lot of time in terms of educating investors. I highly recommend use if you're not familiar with Morningstar, if you're not familiar with the markets as a whole, I would basically advise you to spend time here. You can get a great education just from Morningstar. This also brings up the fact that Morningstar really prides itself in the fact that it is aimed at individual investors. They they quote unquote they're not trying to sell you anything besides their advisory service. Um, they feel that they are an unbiased resource for investors. Now, it turns out that they do also do some analysis for brokerage houses and financial institutions. So they do have a little bit of, I won't call it bias, but they do have a bit of an interest in that part of the world as well. But certainly, their roots are in providing information to individual investors. Oh, question. So the question is, there are lots and lots of financial ratios. How do you tell what's good and bad? For example, a stock has a price to book of 1.3. Well, is that good, bad, indifferent? So I'll give you a couple of different ways to answer that question. The first is that there are uh, it, you compare whatever financial ratio, price to book in our case, to the market and to the sector and the industry that the stock is in. And that gives you a relative idea of, okay, well, is it higher than the market, higher than the industry, lower than the industry, etc. So for example, if you had a price to book of 1.3 on a stock and the sector was at 2.3, you could start to make conclusions like, boy, this looks cheap by this metric. And sometimes being cheap is a good thing, and sometimes being cheap is a bad thing because it's cheap for a reason. Okay. Now, flip side, or another way that you can look at this is you can compare the price to book, or again, the financial metric you're interested in, versus what it has been historically for that company. So many times services will give you a 5 or 10 year history of what price to book or financial metric of your choice is, so that you can say, this stock used to have a price to book of, again, 2.3. Now it's 1.3. Why is it cheaper? Is this a good thing or a bad thing? Uh, Now, but that's two very simple ways that you can get a handle on what's happening with a stock. You compare it to its, if you will, its brethren out there in the sector and in the market, and you compare it to itself in terms of past history. Now, if you're a real fundamentalist type of guy, you do a lot of fundamental analysis, what happens is this may cause you to jump in all the financial statements and cash flow statements and balance sheets and annual reports and just tear things apart and really figure out what's going on with the company. God bless, go out and have fun. What I'm suggesting is literally just a first cut to get a feel for what's going on. Okay, next slide. Uh, so now we're on to S&P Net Advantage. Again, that's the name of the product that they make available to libraries. Uh, Really, this is a pretty good summary of what is available. Standard & Poor's stock reports, company profiles. They have a bond screener. They have mutual fund reports. They have industry surveys, and one of their most famous products is the Standard & Poor's Outlook, or as they call it, the Outlook. So this gives you an idea of what they offer. Um, Going a little bit further in, this is their, if you will, landing page, their home page. Effectively, what they do here is they give you some capability of searching their documents. They provide a number of tabs to specific areas like stocks and mutual funds and such. Uh, they have some quick links to industry surveys and the Outlook and S&P indices. So lots of people just want to go directly there, get an Outlook report and leave, and that's all fine. So this is basically a page that a lot of people click through very quickly. So I'll do the same thing and click through to the next one. So here we're at the company tab. Again, you can research publications on the company. You can get access to Outlook, the Outlook, which is their basic reporting capability on companies. And then they give you a bunch of current features and commentary. So essentially, this is where you'd come in and do stock research. Okay, so in this particular case, let's see. Well, we're basically into industries, sectors, and the economy. Again, you can do some searching here. You have access to some of the various Standard & Poor's publications on industries, segments, etc. So for example, in terms of industry, something that's hot right now is the energy industry, oil explorers. You can go out and if you're interested in an oil company or an oil explorer, you can go over and take a look at what's happening in that sector to make a comparison of what's going on. Next up, slide 35. Here what we're doing is talking about mutual funds. Very similar to what I mentioned earlier. You can get commentaries, you can do search on specific funds, and they also make available a mutual fund screener. Okay, so I know that was a whirlwind tour through S&P. Here we're beginning value line. So interestingly enough, this comes from a report that the library puts out, a PDF the library put out. Apparently they've been having some problems getting people to access value line appropriately. They've been getting a lot of questions. So they put this out, and I basically just try to summarize what they're doing. So first off, as I mentioned earlier, Value Line is a true investment advisory service. They will go out and they cover some number of stocks. I want to say 1,500. That could be wrong, but it's some number like that. And effectively they rank all 1,500 stocks, and they have a 1 to 5 scoring system in terms of 1 being good, 5 being poor, and they put each stock into one of those categories, and with an implication that a stock rated 1 is much better than a stock rated 5. They also have what is called the value line. That's where their name comes from. I'll show that value line to you when we come up to it in the next couple of slides. And basically, surprise, surprise, that is the line that they think, that's what value line thinks the value of the company is worth. Okay, and so if the price is above that, you're overvalued. If the price is below that, you're undervalued. Now you can argue with whether you agree with the value line and so on, but that's what they do. Um, let's see, other things. One of the things is they provide a number of financial ratios. For example, we were talking about price to book. They give you some of the history of that. They also talk about what's happening in the sector, so that gives you some idea of what's going on there. Value line, the reason it's so popular, it's been around since the 60s, I believe. Academics have studied it. Industries have studied it. Industry research centers. It's a very good source of information that's done well overall. Um, so that kind of gives you an introduction to what value line is. It's a little different than what we've been talking about up until now. Uh, with that, let's move along. So what the library is trying to tell you here is once you get to the value line, main page, you put in a ticker. In this case, they put in Coca-Cola. And if you click on that, what happens is you get this next page, which gives you the basic information about Coca-Cola. So for example, it tells you your safety is ranked 3 on Coke. So that's, kind of a middling rank. Your timeliness is 2, so it's, not the ultimate in timeliness, but it's pretty good. It gives you a safety rating of 3. It gives you a financial strength rating of B+. If you go in, you can see these same numbers. So for example, the beverage industry, which obviously Coke is a member of, is they give you some idea of where Coke sits within that. Here, even on this page, they're starting to give you statistics like total sales, cash flow per share, long-term debt over a number of years, so that you can kind of get a feel for how Coke has been performing. So, so that's the basics. If you scroll down, you get to an area where they talk about what I think of as the value line sheet. So this goes back to the old days. Originally, when I started using Value Line, it was a paper service. It was a weekly service, and every week you would get a booklet of about, I'm going to say, 40 or 50 stocks, 40 or 50 pages that covered a particular segment of the market. And you'd have a big loose leaf. It was several, I would say 6 inches thick. It was big. And you'd tear out the one that was several months old for that segment, and you'd put the new one in, and then you went and you made your decisions based on the value line sheet. Obviously, this is all electronic these days. They're put out PDFs, but people still want to see the value line sheet. And so what they're saying is if you want the value line sheet, you got to come down here and you click on the link and you'll get to the value line sheet. So I go ahead and I click, and here's the infamous value line sheet. So I can tell you, this one happens to be for Oracle. I can tell you that it has a timeliness rating of 1. It has a safety rating of 1. It talks about P ratio and relative P ratio and a number of things. You can see it provides information on Oracle, some base financial information going back to 1998. And here, my friends, is the infamous value line. And so you can see for many years up through 2008, Oracle was overvalued by this metric, and now it's in the neighborhood of being fairly valued, okay, because the line is right around where the stock price is. They also give you a projection out here for years 2017 through 2019, what they expect the price to be. And so this is how this is one way of using value line. and in terms of what was my price today, what is a good target price per value line, and I can go ahead make a decision on to buy the stock about based on where the price is today, and if it's going to be 20% higher in 2 years, yeah, that's a good deal, I should buy it. Or if it's overvalued and it's going to be the same price in 2 years, I'll take a pass. So that's basically what's going on. Now, is value line always correct? No, no one's 100% correct in this world, especially in the world of investing. However, as I mentioned earlier, there's been a number of research studies done on value line, and they've done very good over the years. Okay, I certainly pay attention to it and use it. Let's see. Question. What is the value line rating system? It's a 1 to 5 scoring system. Again, 1 being good, 5 being not so good. All 1,500 or however many stocks they cover these days are forced to be ranked in one of those areas. There's a distribution of, and think of a bell curve, a normal distribution. The vast majority of stocks will be placed as rated as a number 3, middling. Fewer good stocks will be 2, and then there's relatively very few stocks that are rated number 1. Same thing with ratings 4 and 5. So effectively what happens is based on their internal processes, value line will change these rankings in terms of timeliness, in terms of safety, etc. So for example, there are all sorts of trading strategies based on this. One famous trading strategy was buy when a stock moves from a rating of 2 to a rating of 1. When it falls from 1 to 2, you sell it. Another one is buy when a stock gets a rating of 1, hold if it's rating of 2, goes to 3, sell it. There's all sorts of trading systems like this, just based purely on the value line ranking system that people have used over the years. Now, to give value line its due today, there's all sorts of rating systems. People are used to 5 stars. They're used to A, B, C, D, E, F. They're used to, 1 banana to 5 bananas, all sorts of rating systems. Back in the day when value line came out and they came up with this simple scoring system, it was, I won't call it revolutionary, but it was a big deal, okay, because they were going out there and giving very specific advice. And remember, this is the 60s, okay, so, and people are running around trading based on these paper books that I was talking about. So to a very large degree, I think value line, if they weren't the first people to do this, were among the first people to do rating, and so they get a lot of credit for that. Next question. Coverage. They cover stocks. I know at one time they had what I think they were referring to as their extended universe, so they had a base universe of, again, I'm going to say 1,600 stocks, and then they had another universe for an extra fee you would pay. I think they tended to be smaller stocks, and you got another 1,000 stocks or something like that. I do not know whether that is still offered. I don't think they've ever offered a product on ETFs, but I can't absolutely swear to that. Okay. So we have already done the questions. So moving on to asset allocation, ETFs, and Robos. Okay, so I'll have to pick the pace up here a little because I'm running behind because as usual, I'm telling a lot of side stories and babbling along. So what is the goal here? Um, Asset allocation, under asset allocation in ETFs, there's a powerful freeware portfolio backtesting simulation tool that I want to introduce you to. I guess one thing that I'll mention here for the purposes of this talk, I will talk about asset allocation in ETFs, and I kind of treat them as the same thing here because when I think of an asset like the S&P 500, I think about investing in it with its ETF, the SPY, or commodities would be DBC, among others. There's a number of commodity indices. So as I talk, sometimes I'll talk about assets, sometimes I'll talk about ETF. I'm really talking about the same thing for this particular area. So we'll talk about this portfolio tool for assets slash ETFs. And then there were a series of articles about robo advisors in the journal and the CI newsletter. I'll give you a brief overview of those. Main resources, the name of the tool is Portfolio Visualizer. I'll give you some background on their capability, where they come from, and then again, as I said, it's the AAI Journal and Computerized Investing newsletter. And with that, next slide. Okay, so this is the Portfolio Visualizer site. Basically, they are a Portfolio Visualizer is a tool created by Silicon Cloud Technologies. Silicon Cloud Technologies is in Austin, Texas. They are a software company focusing on financial platforms, financial analysis tools. So that's what this is where it comes from, if you will, in terms of what they do. They sell this their real tools to hedge funds, brokerages, analysts, and they're making these, relatively simplistic tools available to us. Now, I use that with tongue firmly in cheek because, as you'll see, some of these simplistic tools are actually pretty powerful. Okay, next up. Okay, so here we're in the basic asset allocation screen. I'll just kind of walk through it with you. You can set a start year and an end year. Start year in this case can be as early as 1972. You put in an initial amount. I threw in $10,000. Annual adjustment, that deals with essentially, can you make do you want to make a contribution every year, or do you want to make a withdrawal every year? And then how often do you rebalance to your set allocation? In this case, I did it annually. And you can put in a benchmark, things like the S&P 500, 400, or 600. Down here is where you actually would put in up to 3 portfolios, and you put in a percentage of various asset classes. So, for example, the U.S. stock market, you could put in, the U.S. stock market, you could put in 10% of your money, 60% of your money, etc. You can see they've got large cap value, blend and growth, mid cap value, blend and growth. If I had an infinitely long screen here, I could go back and show you the many multiple asset classes they make available to you. And again, there are ETFs that follow each one of these indexes. So that's why you can rest assured that you can actually invest in these things. Okay, so next slide. So I went through and I picked a few sample asset allocations, many of which are quite well known. So the top one is 60/40 stock bonds, very famous, very simple. The next one comes from Christine Benz of Morningstar. She was presenting to us back in June to the chapter, and she presented a particular set of assets and ratios or percentages you should invest in each. And so I just took that and threw it in there. And then we talked a little bit about Meb Faber and his Faber 5 portfolio where you have 20% each in U.S. stocks, foreign stocks, bonds, commodities, and REITs. And so I threw that in there. So three reasonably well-known and quite totally different asset allocations. Let's see what happens. Okay, on this slide, let me start down here with the EC. What you have is back in 1984, you start with $10,000, and today the three different asset allocations that we talked about, rebalanced annually, end up making a ton of money, as you might expect, over 32 years. Just so you know what you're looking at, Portfolio 1, the blue curve, is 60/40. Portfolio 2, the red curve, is Christine Benz Morningstar, and Portfolio 3, which is the gold curve, is Meb Faber's Faber 5. So two things you can immediately state is, well, gosh, somebody wins, somebody loses. Over time, who was winning and, pick a particular year, who was winning and who was losing changes. Excuse me. Right now, Meb Faber's 5 is on top, and Christine's Benz's Morningstar portfolio is below, but that's changed over the years. But probably the more important thing to notice is, they're kind of the same. Okay. I mean, they've reacted the same over time. Yeah, there have been big winners some years and big losers in others, but it's a horse race. There's not something radically different. There's not one that is really horribly poor. And so that tells you something, okay, in terms of even the simplest 60/40 stock bond asset allocation, which is, that's again the blue line, came very close to the best curve, which happens to be the Faber 5 as of today. So, geez, seems like even doing some basic asset allocation tends to do pretty well. Okay, so up top, at the top here, you've got they get a number of statistics again that you can get dumped out of the tool: initial balance, final balance, CAGR. That's again the growth rate, the standard deviations of the portfolio, best and worst year, the maximum drawdown, Sharpe ratio, and they also give you U.S. and market correlation, so you know how closely correlated a particular asset allocation is to the U.S. market or the international market. Question? What is CAGR? That's compound annual growth rate. That's compound rate of return. It's a geometric return. So for example, as opposed to linear returns or average returns, where if you made 10% a year on average, it take you 10 years to make 100%. Geometric returns, very roughly, if you make 10% a year, you double your number in 7 years, because you're compounding, i.e. you get to grow the interest you get paid every year. Question. Why is it free? Good question. I think it's basically coming down to advertising. I mean, they're a software company and they want to show what they can do, and so that they've got good stuff here, and so I think that's why they're doing it. Also, to give you an idea, I mean, any good grad student, if you had an undergrad in computer science or computer engineering, and now you've done your MBA courses and so on, or at least you're familiar with the quant part of the MBA courses, be relatively simple to crank this out. Okay, so it's good stuff, but there's nothing earth-shattering here. Most of the stuff has been around a while, like decades. So again, I think it's mostly advertising. Question. Who did the best? Oh boy, that's hard to answer. Okay, so if you're looking at CAGR, compound rate of return, it's MEB favor at 9.7. The worst was 9.1 for portfolio 2, which is Ben's. Now that's today, and you can pick past years and you'd get a different answer. Now, to kind of beat up on the Faber 5, if you go back to the 2008-2009 era, and you look at max drawdown, portfolio 1, which is 60/40, only had a 20% drawdown, and our buddy Meb Faber had a 31% drawdown. So, okay, who's best? Okay, do you look at max drawdown? Do you look at compound rate of return? Sharp ratios are really tight, 0.58 to 0.61. So that basically says you're taking about the same amount of risks for the reward you get. So one of the things I guess I will mention in Christine Ben's Morningstar's favor is that they're set up to, that portfolio set up to provide a cash buffer for people that are in retirement and taking money out of the account. So they've got a bit of a drag in terms of performance because they just got cash sitting there to some degree. Whereas the rest of the other two portfolios are a little bit more active in terms of being in funds that should give you money. So that's what's going on there. To put the drawdown or the max drawdown in perspective, if you had $1 million invested, a 30%, 31% drawdown is one day you wake up and you go, I'm down to $690,000. Whereas if you were in 60/40, you wake up and you go, I'm down to $800,000. Now, people are going to react in different ways to those numbers. I also remind people that 2008, 2009 was financial crisis, biggest one since the Great Depression. So it's a little bit of a stress point in terms of making decisions based on that one year. But it happened. You can't ignore it. And so that, this gives you an idea of what would have happened to your portfolio. And now you have to ask yourself how you would have reacted. Question. Okay, what is the Sharpe ratio? Again, it's 0.58 to 0.61. Turns out that 60/40 has the best Sharpe ratio. As I said, they're all clustered together, which again, it kind of says you're getting about the same amount of reward for each unit of risk you're taking. Okay, next up. So here's all the information that you can download. Effectively, they give you a year-by-year return for every asset class, like U.S. stock market and total bond market and international stock market, etc. They give you that every year. They also give you the inflation rate every year. They then give you the gain of each portfolio every year. And then they inflation adjust the return of each portfolio every year. So you know what the return is in terms of real returns. So again, I just copied a couple of the years here to give you a feeling of the type of data they give you. Really, if you're interested in this, you can download it into a spreadsheet and handle it from there. Next slide. Okay, so another nice thing they provide is a 3 to 5 year rolling return, i.e. how much money have you made in the past 3 years, the past 5 years. Um, the blue lines are 3-year return, the red lines are 5-year return. So the first thing you can see is that in terms of the best portfolio, 60/40 had the best 3-year rolling return. In 2002, not 2008, okay, 2002, that bear market, uh, they had a 3-year loss of, I'm going to eyeball it at 4%, okay. So that means over the last 3 years, they lost 4%. And then every other year, they made money, with the exception of 2008, where it looks like I'm going to say they lost 2%. So that's very important to people, especially people in retirement, because they say, I know after a 3-year period, very unusual for me to have a loss in my portfolio. 5-year period, no losses at all. Now, the quote worst portfolio was the Ben's Morningstar portfolio, where they had 3 years where they had a 3-year rolling loss. They had 2002, 2008, and I think it's 2009. Okay, very slight loss in 2009. No losses on a 5-year basis. So again, you can make your decision as to how important these sort of rolling losses are to you, but the tool provides those to you. Okay, slide 49. Here, what I did a run where you have exactly the same assets, exactly the same strategies, only now I'm withdrawing 4% per year. So this models a simple retirement withdrawal strategy where I've got some money. I hope that portfolio grows, but every year I take 4% out to cover my costs, if you will, the cost of living. Now what happens? Well, before we were talking about 170, 180K. Well, now, you end up with around 41 to 50K at the end, starting with 10,000, so you still make money. However, your CAGRs are now down to 4.7 to 5.3%. Again, 4% of your money is being taken out every year, so this makes sense in terms of what the numbers you're seeing. So that's and you get the same statistics as before. You just get it shows you essentially what would happen under this set of conditions. Now the next slide gets more interesting. A question? Withdrawal rate. The withdrawal rate again is 4% each year. How I would use this in a case if you've got a real portfolio, I would adopt an asset allocation strategy you're happy with, let's just say 60/40 since it's simple, and effectively the amount of money you would have. So let's say it starts at $1 million, just to make the math easy, and you would be able to see historically over the last 32 years what would have happened in terms of the money coming out of your the money that you get to live on every year. And that actually does speak to the next slide, which talks about what are your annual returns every year. In this case, you can track it by portfolio. However, the key thing is the bottom graph in terms of how much money do you withdraw. I'm going to inflate this up to $1 million, not 10,000. And so at the end of the first year, you would have been taking out, eyeballing things, you would have been taking out just slightly less than $60,000. And in 2015, at the end of that year, you would have taken out, call it 180 to maybe $210,000. And the reason that number is so radically different is your portfolio grew over the years. There's also, this is nominal returns, not real returns, and so you've got um, you have to factor inflation in there, but basically it's mostly growth that is driving that. Now, slide 51 uh, gives you, it's the same stuff we've talked about before, gives you all the data. They've got, they factor in inflation, so I can tell you, for example, uh, the portfolio year-end inflation adjusted returns every year. So they knock inflation off. So for example, in 2015, it looks like portfolio one, you actually lost a few dollars in real terms. Where you made the inflation adjustment's always negative, so it's about $2,000. You would have made $48,000, I think, in 2015, starting with $10,000. So you have to add a few items there. Okay. Questions on this? Okay, so the gentleman brought up a question that, hey, this is all back tested and so on. Yes, this is back tested on history. It is what you would have seen, not what will happen, obviously. The site does have the capability for projecting into the future in terms of saying, hey, on average, we used to make 10% a year in stocks, now you're going to make 8%. You can project that into the future and run a Monte Carlo simulation that will give you 10,000 different possible futures, and you can do a statistical study. Or statistical limits in terms of, at the 95th percentile, I will make X number of dollars per year if I have a 4% withdrawal rate. You can do all that at the site. We don't have time today to get into that, but the site can do that. Can you get the data out of the tool? Absolutely. Everything I've shown here, you can download and put into a CSV file, and then you can manipulate it to your heart's extent. So another question. Okay, so the question is, effectively you put in numbers, your portfolio, if you will, your net worth, whatever your retirement funds in here. You're providing information to these people. Yeah, that's a problem you have whenever you put your personal information into any kind of tool, freeware or a paid service. One simple way around that is to multiply your number, your numbers, your real number by some factor, 2.3, your age divided by 8, some completely bogus number, and that way they won't have your real numbers. Okay, no more questions. Next up, we're now into Robos. So what are Robos? This first article by Matthew Bajowski talks about what are Robos and what are their pluses and minuses. So Robos are are essentially automated portfolio management and advice, i.e. computers spitting out the numbers of what you should invest in. Their main goal is to make investing easier. Okay, i.e. you don't have to figure all this out. The computers will. Okay. The term is loosely applied to a whole bunch of different services that do things in different ways. They're called Robos. Now, I understand from reading these articles that that's sort of a negative term. They prefer to be called online investment advisors or investment advisory services, and that's nice. They're Robos. Okay. Next up, they tend to bucketize investors. Now, what that means is typically off of a survey of about 10 questions that they ask you to get a feeling for what your goals are and what your risk tolerance is. They will then say, okay, we think you are a conservative investor with a goal that's 20 years out, so we're going to put you into this investment class. Or we think you're an aggressive investor that has a goal 40 years out, and we're going to put you into a different investment class. So that's what they mean by bucketizing investors. Robos aren't the first people to do this. Plenty of people bucketize investors, including CFPs and RIAs. Last point in terms of robos, or what robos are, decision-making process. How do robos make a decision of what asset classes you should be in? It's basically MPT, margin portfolio theory, all the things that Fred talked about in the last couple of talks. That's what robos do. Now, weaknesses. There are several. First one is you really don't have a person to talk to on the other side. As I said, they may do this survey with 10 questions, and then actually talking to a person may be difficult. You may be able to write emails. You may be able to have a chat. You may be able to write a question into a web page, but you don't have a registered investment advisor, a CFP, or a human being there to hold your hand when things get rough. Okay. Now, robos may not act in the client's best interest. Number one, humans program computers. Duh. Yeah, I don't consider that a big deal. Every RIA, CFP, every brokerage firm, they've got computer programs, and as far as I know, human beings can, factor into computer programs. So that's a no-off for me. Each robo uses different rebalancing bands. Now that's true. You could rebalance monthly, semi-annually, yearly. You could rebalance once only if you're outside 10% or more outside a target percentage. All that's true. Again, different RIAs, CFPs, financial institutions, all have different rebalancing schemes. I don't hold that against robos. They have, they are different as long as they tell me what they're doing and I agree with it. Okay. So again, that doesn't hold much water for me. Now the last one is that robos may in fact use affiliated brokers, clearing firms. This basically gets into the last point also about costs. Robos, their main purpose in life, if you will, is to drive investment advice, the cost of investment advice down. They're commoditizing investment advice, if you will. However, and they do that, and they talk about we've got really cheap fees, or you can put in $2,000, or you can put any amount in at all. Okay. And they give the impression that you're getting a lot of things free or very cheaply, and the fact of the matter is that may not be true. You may, in fact, have hidden fees in terms of the costs of the underlying ETFs, management fees for them. They may be have a number of costs that aren't obvious to you. Okay. Now robos aren't the first people to do this. Lots of target date funds also have hidden layers of fees or multiple layers of fees. But they're not, I certainly agree, they are not necessarily as cheap as, their marketing makes them out to be. Next up, Wes Gray, Robos. Why use one? Wes Gray has he's a RIA CFP person. He's got his own Robo technology. Uh, as you saw before, and he starts off really well. It's really a good fit for small investors. Um, as I talked about, managing a portfolio costs labor, i.e. you have to pay for it. Lots of professional advisors for a managed account say, hey, you got to give me at least $1 million. Assuming they charge you 2% for that, that's only $20,000 a year. They have to pay for their time, they have to pay for office expenses, trading expenses, etc. And it costs money to do all this. Uh, and so basically, a robo drives a lot of those costs down. You get the advantages of more modern portfolio theory. And so you can drive the account costs down because it's all automated and you've taken the labor costs out. Second point, they automate the discipline needed. So we've talked tonight about, selling low and buying high, okay, due to emotions. And quite frankly, that's one of the hardest parts of investing is adhering to your plan. If people just adhered to their plan, they'd be much further off. But what they do is a bear market comes along, they panic and they get out, and then they don't get back in until the stocks are high again. Classic. Since this is all automated, robos essentially save you from yourself. A computer program doesn't care whether the SPY is up a lot or down a lot. It's going to do exactly what it's programmed to do. And so it's not going to worry when when you have a bear market. It will just run the numbers and do whatever it's supposed to do in terms of rebalancing. Okay? And so it saves you from yourself. Next part, robos save time. Absolutely. Okay? It's a fire and forget. Use this asset allocation strategy. Boom, I'm done. I got a life to lead. Okay, and yeah, you check in once a year or whatever, but you got a program there, watching out for you, taking care of you, if you want to think of it that way. And the last point, and I have to admit, I appreciate this myself, is they eliminate pushy salesmen. And if you've ever dealt with a classic stock brokerage, and even RIAs and CFPs and so on, they've always got the new strategy, the hot new ETF, the hot new product. I'm going to call Al up and, Al's a good guy. He'll buy from me, right? Well, to some degree, hey, these guys got to make their money. I understand that. But, to a large degree, you don't have any of that. Here's my money, implement on that asset class, rebalance once a year or whatever you agree with the robo, and, I'll see you. Okay, send me your report every month. See ya. Okay, let's see, next up. Sharon Mallory. This is interesting because she is in fact an RIA, and so she's looking at it from that viewpoint. Again, she takes a look at it in terms of, she makes the point that there's nothing new here in terms of technology. Investment advisors, RIAs, have had these class of tools we're talking about tonight multiple years. I'm going to say multiple decades. So there's nothing new here. It's cheaper now because robos are commoditizing it. So, and that's a good thing. And as we just talked about, that means this technology can be used for smaller and smaller investments amount. But effectively, you can the ARIA can help you out more. And one of the things that's happening with registered investment advisors are they are tending to become the human face to robos. So you talk to them and they offer you financial advice backed by a robo, but they also, can handle wills and estates and any number of other, insurance product needs and any number of other personal financial needs. Tax efficiency. So this is one thing that if you're in a normal taxable account, you can do what's called tax loss harvesting, which at the end of the year is, if you've got some losers, you can sell them and help and get a reduction on your taxes, hopefully. And, Uncle Sam gets to share the pain with you. And Robos will do that automatically for you. And there's different levels they'll do it at, but they'll will certainly do that for you. Uh, Last point, lower cost, that gets again to the fact that a small RIA now has the same tools that a lot of the big guys do, and so they can pass on cost savings to investors in one way or another. Okay, so Jacqueline again put together a very nice article, and what I did out of that article, she's got a nice table of about, I want to say about 20 robos, listing a number of features. So, for example, do they provide financial advice? What securities do they use? ETFs or stocks? Do they provide tax guidance? Do they provide with retirement withdrawal guidance? Do they manage your money, or do they just give you advice and you have to hit the enter key? How do you communicate with them? Again, I mentioned earlier, some of these sites are just a website or a mobile phone app, and if they provide a phone number, it's because you're talking to somebody off in another country, and they'll get back to you. Okay. Um, they talk about the fees. Okay, how much are they going to charge you for this? And they talk about minimum account size. I copied two of the uh, better known robos, independent robos, Betterment and Wealthfront, just to give you a feel for what the numbers are. You can go to Jacqueline's article and get a lot more um, data there. Oh, question? Who puts together target date funds? Okay, so lots of people. Uh, so target date funds again are based on the idea typically that they're tied in strongly with retirement, that at the end of the target date you will be retired. Uh, so, for example, if you've got a target date 2010 fund, that means you're already retired. They will still have you somewhat in stocks, but you're probably much more into income producing assets. Versus if you've got a 2060 retirement date. That's probably for someone in their 20s or their 30s, and that's probably pretty aggressive because you should be in the growth phase. So they're going to be a lot more into stocks than they are into income producing assets. Now, who actually puts these together? Lots of people. I mean, Fidelity has theirs, Vanguard has theirs. Um, I would imagine almost, most companies in their 401ks have some version of a target date fund. I mean, this is very, very typical stuff. Um, Now, how are they formed? Basically, some human analyst goes out and essentially says, yeah, for an aggressive fund, we should be more in stocks and we should use these funds or ETFs. And for a conservative fund, near in term or coming due soon, we should be more income producing. And they probably use a tool that looks a whole heck of a lot like what the robos are using. Now, they may not come up with the same mix the same way that robos don't necessarily come up with the same mix, but they're going to follow the same process for the most part. Um, and as I mentioned earlier, target date funds will have the same problem that robos do in terms of, your classic target date fund. You pay a management fee for the target date, and then they use their, underlying funds that also have management fees. So you may be paying double fees in your tax funds, in your target date funds. To a large degree, and that's why, at least partially why we're here tonight. You can do it cheaper yourself, meaning, take the 60-40 fund we were, or 60-40 split we were looking at earlier. Geez, does pretty good, and I can do one trade per year at Vanguard with total stock market versus total bond market for the U.S. Do a trade a year, done. Okay, I don't need to pay a whole lot of people to do that for me. Next question. Does Vanguard have a 60/40 fund? Um, I don't know. They may not have I don't think they have a pure 60/40. I could be wrong. I'd have to check. Again, as I just said, you may be further ahead buying Vanguard total stock, Vanguard total bond, and just doing 60/40, once a year yourself. Okay, next up, Wealthfront and direct indexing. This will be the last thing we talk about tonight because I'm running real late. Um, so what most robos do, and I'll start on the left-hand side here, what most robos do is they decide a certain percentage of your money should be in the total stock market. They use VTI, which is Vanguard's ETF for that, and you get a chunk of that. And at tax time, if you've lost, or tax time being the end of the year, if you've lost money on VTI, they'll sell it and they'll buy something similar to VTI, and that way you get to capture a tax loss. Now, what our friends at Wealthfront have done is they actually go in there and they'll buy the individual stocks underneath VTI. So they will own hundreds to thousands of stocks, and they will do this tax harvesting virtually every day. And what that means is, for example, let's suppose you've got Coke, you own Coca-Cola, and you've got a loss on Coca-Cola, okay, for the year. What they can do is they'll say, I will sell Coke and take that loss and do wonderful things for my clients as far as tax harvesting goes. But to replace Coke, what's a stock that might look a lot like Coke? Pepsi. I'll go out and buy some Pepsi to replace the Coke. Okay. Now they do this all with, comparing stocks in terms of their performance and how alike or disalike they are, i.e., correlations. They do this all, in detail, very mathematically. And so it's not, some guy back there, fat thumb, as I just suggested, with Coke and Pepsi. So they do this very precisely. They have a nice white paper on their site that talks about this. You can go visit that white paper, or go download that white paper and read it. The academic claims are that if they do this right, you could get up to 2% more per year compound annual growth rate. That is a big deal, okay? Now, there's all sorts of conditions around that. Obviously, you have to be doing this in a taxable account or the taxes don't matter, right? So you ain't going to do this in your 401k. But, if you're exposed in this way or you have this concern, Wealthfront will help you, if you will. Okay, so with that, I'm unfortunately, because I'm out of time, it's almost 9 o'clock. I'm going to skip shareholder yield. I'm sorry. I apologize for this. I'll see if I can add an extra session at the end. When we post the recording, I'll see if I can't do a recording for shareholder yield so that you get the full coverage. What I will do now is just jump to the summary for the session. So again, in terms of the introduction, hopefully I gave you a little bit of an idea of what the Financial Planning Workshop series is about. We did cover some top investing websites. I gave you some pointers to the articles. We can find all of them. What we post at our chapter website will have more than what I covered. We also talked about some useful spreadsheets, both Excel and Google Sheets. If you want any of those, please just send me an email. I'll get them to you one way or another. We talked about resources that you can get here at this library in the Santa Clara County Library System. Your own local library, you're going to have to check yourself, but go online and take a look. See, it's free brand name advice for you to use. We talked about asset allocation slash ETFs, and key thing is I gave you a pointer to a portfolio visualizer, which hopefully you can go off, and they've automated a lot of the grunt work so you can figure out yourself what you're doing. And we also touched on robo-advisors who also use ETF and MPT to manage money. And the one thing I did, skip over stock screening. Again, sorry. One more thing. Now that we're done with introduction to computerized investing, next month, Fred will be back, thank God, and he'll be talking about active versus passive investing strategies. Fred tends to be a passive type guy. I respect that and agree that it's certainly the best. Vast majority of people would benefit from passive investing. However, I tend to be more on the active side. So over time, Fred and I have thrown a little mud at one another on this topic. So we'll see next month whether we get into that. And then there's future sessions on retirement planning, et cetera, et cetera, et cetera. So I'll take one or two final questions here. So on the Robo table, if you will, the question is, where do you find the Robo table? It's at the AAII journal. They have the full table. They have, as I said, fees. You can see the fees for Betterment and Wealthfront earlier. They have minimum account size, etc. Now, Robos tend to be very popular among young people because they don't necessarily have a lot of money and to invest, and so they may only have a few $1,000s, and some of the robos will say, sure, fine, no problem, throw it in the bin, we'll manage it with like everybody else's money, right? And so in some cases you can't even buy a mutual fund for the sort of investments that some of the younger folks are making. So effectively, that is one of the attractions of Robos, is the small amount of money. In some cases, $0. They'll start managing your money for you. Okay, so the question is contacting them. Again, Robos tend, and many other services these days as well, don't really want you to call them and talk to a human because that costs too much money. They'd rather have you work with them through a chat or a room or an application or an email or what have you. And many times that's fine. If you do call them, expect to go through a call chain, meaning when you call them, you'll talk to some automated voice and have to hit half a dozen numbers to get to the right menu to actually get what you want. Okay, so we're winding up the webinar. We're out of time here. So at this point, what I'm going to do is close things down. I'll stick around here for the next 5 to 10 minutes and answer questions. Again, thanks much for hanging in there, and hope to see you next month at the passive versus active session. Good night. Hello, this is Al Smoswelski again. As promised, even though we didn't get to the topic in the library, I did make a separate recording where we'll be talking about stock screening analysis and how you can implement that. Moving right along, the first slide here talks about the goals for stock screening and implementation. And so again, the idea here is to implement or talk about implementing a very simple stock screen to illustrate the process. We're not going to be going in depth on this. I have given plenty of stock screening presentations over the years, including a fuller version of the one we're going through here tonight. And it took 90 minutes and we've got 30. So obviously we're going to just do a simple overview of some of the screen and unfortunately leave out some of the details. So where did this information come from? The main resources here is a book written by Mebane Faber, or Meb Faber, called Shareholder Yield. SYLD, by the way, is the ticker symbol for Meb's ETF in this area. He has written a book on this. It's an ebook. It occasionally goes on sale for free at Amazon. In that book, he describes the overall process and equations that I'm going to be using tonight. In terms of the tool, as I mentioned earlier, Portfolio 123 is both a screener and a back tester, so I will be using that. Stock Investor Pro can also be used to run the screen. There's no back testing capability with Stock Investor Pro. So next up, more in terms of the introductory comments. I've already mentioned about Portfolio 123 versus Stock Investor Pro. I get questions about whether you can build this same screen in Stock Investor Pro, and the answer is yes, you can. I've done it. Due to slight discrepancies in databases and so on, you may come up with slightly varying stocks when you run a screen. However, the basics of the screen remain the same. Now, one comment and question I often get in this area is, well, geez, there's plenty of free screeners out there. Yahoo's got a screener. Various brokerages may have screeners, etc. Can you build the shareholder screen inside a free screener? And the answer, as with many things in life, is it depends. First off, the free screener may or may not have the fundamental data that we're going to be going over, so that's necessary to implement the screen. So you may be out of luck there. The other thing to watch out for all free screening and other free investment tools is the quality of the data. Where do they get their data from? To some degree, there's an old computer programming saying that at least comes from the 60s, probably earlier. GIGO, garbage in, garbage out. If you don't have good data coming into your screen, the results are at best questionable. The next question I get very often is, do you need to have a backtesting tool? And the answer is no. Unless you want to do analysis similar to what I'm going to be talking about tonight, there's really no need for it. I use a backtester to essentially build my faith and confidence in the screen or the approach that I'm using, that it works historically. If the backtester has the capability, maybe it works looking forward based on statistical runs and so on. It lets me say, yeah, this has worked for the last X number of years. It's worked through bear markets, bull markets. This is what you can expect the screen to do, etc. So that's why I do backtesting. If you have faith in a screen you come up with or are provided, because they've either done backtesting or for whatever other reason, then yeah, you don't need to do backtesting. Now, if you want to do backtesting, as I said, I use Portfolio 123. Again, there are some free backtesting tools out there. As I mentioned earlier, they have limited capabilities, perhaps, in the type of terms they give you in terms of backtesting and the sort of capabilities. And you always have the general issue of quality of data. Okay, so moving along, more introductory comments. Do I use other tools? Uh, yes, my answer is yes. I typically dump the equity curve that comes out of Backtester or the screener into an Excel spreadsheet and further manipulate it and create reports and compute other variables, do other things with it. But that's myself. You don't really need to do that. Some people do the same thing I do in Excel. They write code. So again, it depends on what you want to do going forward with the information that comes out of the screener. But you certainly don't need to. How much time does this take? That's probably among the most frequent questions that I'm asked. And there's really two answers. On the analysis part, running the screens, doing back testing, twiddling screens, looking at factor A versus factor B, those sort of things, that can take considerable time. Now, I'm okay with spending that time because I find it very interesting. I learn a lot about individual companies, about screens, about the market. So I'm happy doing that because it's a learning experience for me. Others are not so interested in it, and that would be a chore for them. Now, in terms of actually implementing the screen, once you say, yes, I have a screen and now I want to go implement it, this can be a very small amount of time. Even if you're running a screen monthly, which would mean that at the end of every month you run the screen and generate a set of stocks to trade for that month going forward. So you run the screen at the end of September for the stocks you're going to own during the month of October. Screeners run very quickly. I mean, we're talking seconds. So there's maybe 5 minutes running the screen, and then depending on what brokerage you use, you've got the time to enter the trades at your brokerage firm. So, and that's if you do it every month. The screen we're going to be talking about today is a yearly screen, meaning that you run it once per year. And so basically, you know, everything I just described happens once a year. So I don't know, you might spend half an hour uh, implementing a screen once a year. So it's not very heavy in terms of time commitment. The next question that I get very often is, well, should I do more with the screen results? So you run the screen and you get 10 stocks or 25 or 30 or whatever number of stocks the screen produces. And do you just take those and run with them, or is there some additional factors you should consider? So certainly AA recommends you do further analysis. That's kind of a standard boilerplate they put on every one of their articles. Uh, and that's fine. I know people who after they run a screen, if you will, tear apart the companies, and from a fundamental viewpoint, they look at balance sheets and so on. They take the screen as the starting point of what they're going to do. Same thing with, I have a number of friends who are chartists or technical analysis type people, TA people, and they like to look at charts and trend lines and moving averages and any number of indicators to tell them that this is a good stock to buy. Feel free to do that. My general recommendation is that if you were normally going to do that sort of analysis and you want to have 25 stocks you're going to invest in, run the screen for double that, i.e. run the screen and get 50 stocks, and then look at your charts, tear apart your companies and so on, and pick the top 25. All that does is that makes sure that you're still dealing with a good universe of stocks because you ran the screen on them. And then you're putting in your value add, if you will, by looking at all the other factors, be they fundamental or technical. Now, if you do take the raw screen results, and I have to admit I'm in that camp to a large degree, I take the raw screen results and implement the screen because I don't think I add a lot of value doing fundamental analysis or technical analysis. Please do a sanity check on the stocks. Companies are acquired, so you can take a look at a stock chart in seconds and say, it's been at the same price for 2 or 3 weeks. Why is that? Oh, they're getting bought out. Okay. Same thing where you can see a sudden, unusual dive in the price of a stock. And you read some news and it turns out that, well, the CFO was leaving the company under the shadow of basically inappropriate actions, i.e. he may have cooked the books. So those are the sort of things you're looking for. And I suggest you do that in terms of if you're going to take the output of the raw screen. Okay, next up. Now we're getting into the shareholder yield screen itself. So this screen is based on a event that Meb Faber gave the Silicon Valley chapter back in May of 2013. It's based on his book Shareholder Yield. You see it there, a copy of it there. As I said earlier, it's occasionally free at Amazon. Unfortunately, he put all his books on sale for free a week or two ago to celebrate his anniversary of being a blogger or something like that. Some anniversary he had. And so I don't think they're going to necessarily be free again, but you can monitor them and pick them up for free. Now, so I'm going to take a couple 100-page book here with all sorts of charts and graphs and boil it down to 2 slides. So getting right to it, basically what is shareholder yield? Shareholder yield is dividend yield plus buyback yield plus pay down yield. So what is buyback yield? It's basically many companies when they have extra cash and in their viewpoint they can't figure out any other better way to invest that cash than literally investing it in their own stock. They go out and they buy back their own stock on the market. A variety of companies have done that over the years. So what you're measuring here is how much money / how many shares of stock have been bought back in the last 12 months. It's that simple. Now, pay down yield is basically a company can also take extra cash and say, I want to pay down my debt. That does a couple of things. Number one, completely off the side, not having anything to do with shareholder yield, is the fact that they're reducing their leverage so that if they run into tough times in the future, they effectively have a chance to either borrow more money or at least make it through a tough time. The other thing it does is basically companies have to pay interest on the debt they take out, just like you and I do on loans we take out. By paying off the debt, they get to lower their interest expense. So that's another reason why they do it. And that's the gain that we as shareholders see, because instead of paying money to the bank for the interest, you essentially get money, that money comes to you in terms of increased earnings. So one of Meb's major point in the book is that all three of these terms give shareholders return. So we're all aware of the fact that there are people who look at dividend paying stocks because they want to get that dividend once a month, once a quarter, what have you. And so that's why dividend yielding stocks, high dividend yielding stocks are popular among a certain part of the market. There are all sorts of people who have exploited buyback companies that are buying back their stocks. In fact, the two ETFs I mentioned below, PKW and PFM, deal with dividend achievers and buyback achievers. So there's already ETFs out there doing this sort of thing. These are well-known phenomena. And so shareholder yield, again, SYLD is the ticker for that ETF, implements this strategy for U.S. stocks. And MEB has another ETF, FYLD, for foreign shareholder yield. So basically developed markets, high shareholder yield stocks in developed markets. Next up. Okay, so why is this a good thing? So this slide here comes from a blog entry Meb made 3 or more years ago, before the book, where he was talking about shareholder yield. And what he's done here is he's run different screens and then back tested them. He back tested them from 1982 to 2010. Basically, he took the S&P 500 and he took the top 25% of the stocks by either dividend yield or buyback yield or pay down yield, and then combined them all into shareholder yield. And effectively, he'd hold them for a year and then do the same thing again. So this back test ran, let's call it 18, 19 years. And every time he did this, he used market cap weights, not equal weight, but market cap weights inside the when he rebalanced in terms of how much money to put into each stock. So you can see in the chart here that the S&P 500 made, called it 11.3%. The top 25% dividend yielders made 13.3, 2% more. The top buyback stocks made 13.7. That would be 2.4% more. The top debt paydown stocks made 13.9. So again, you're talking about 2.6. And lo and behold, if you combine them all together, the shareholder yield equation says you made 15.5, which is 4.2% here, if I can roughly make an approximation. So there's lots and lots of gain here for a very, very simple strategy. And that's why I'm doing the talk on this screen. Okay, so how do you implement this? I'm going to show you how you implement it in the Portfolio 123 screener. The terms at Stock Investor Pro are similar. If anybody really wants to see the Stock Investor Pro terms, shoot me an email. I'll be happy to give you a screen capture of them. Starting off, you start off over here, just so everybody knows, I ran this screen on November 8th, and there were a total of just under 6,300 stocks in the database. This first term says, give me the S&P 500. That's why you see 500 stocks show up. The next term basically says that over the last 20 days, which is relatively speaking about a month in terms of trading days, make sure that every stock trades at least $1 million per day. Now, the reason I put that term in, and I put that term into every screen I run, is to make sure that the stock is liquid, i.e., I can buy and or sell the stock relatively easily. So my quick rule of thumb is I buy 1%, no more than 1% of the outstanding trading volume. So for $1 million, I could buy $10,000 worth of stock. Now, if I'm buying 25 stocks, that's $250,000. That's a fair size portfolio. Okay. Obviously, if I'm trying to put millions into a portfolio, that number and the stocks I have to trade have to go up in terms of their liquidity, or else you're going to be buying more and more of the daily volume of a stock. Now, in this case, all 500 stocks of the S&P 500 meet that criteria. That's not surprising at all. The next three terms basically go through and they compute a variable for pay down yield, for buyback yield, and then it computes shareholder yield, which is dividend yield, plus pay down yield plus buyback yield. So that's exactly what MEB's equation is. So that's what these three terms are. I'll jump back to those in a second. But once you have shareholder yield, the next thing I do is this ranking command basically says take the S&P 500, rank it by shareholder yield, descending, so the top one is the highest shareholder yield, and give me all the stocks in the top 70th percentile and above. So that's where you see the number go from 500 down to 151 stocks. So that's the big picture. Jumping back here to some of the equations for pay down yield, for example, what the terms here basically says are take the debt that the company held a year ago. What's the debt today? If the difference is negative, if the difference shows that you have less debt today than a year ago, that's positive. And essentially you turn that into a percentage so that you have a yield. In this case, pay down yield. Similarly, for buyback yield, you say, well, there should be fewer shares of stocks today. So you go out and you say, what are the fully diluted share count a year ago, the fully diluted share count today, and what's the percentage, hopefully the percentage reduction. So that's how you compute a buyback yield. And I have some terms down here to give you a little bit of further explanation about what those terms mean. So when we go offline, you can kind of study those and figure out whether that's meaningful to you or not. Okay, next up. Everyone always wants to know what the stocks are. I find that, amazing. Huh? So when I ran this screen back on November 8th, this is what came out. You get the ticker of the stock, you get the name of the stock, you get the last price in the database for the stock, you get the market cap of the stock. Then you have a column with pay down yield, buyback yield, and shareholder yield. Dividend yield is all the way over here on the side. And then you have, if you want to compute things, it gives you the subterms for both the debt and the share buyback areas. Everybody always wants to know what the number one stock is. It's in this particular screen, it's Navient. It has a 39.6% shareholder yield, and that's because, excuse me, they have paid down debt to the tune of 22%. So this is very, very, very unusual. A much more common situation is the number two stock, H&R Block. Yeah, this is the tax people. Their shareholder yield is 20.8%. 18.9% of that comes from buyback yield. They have a negative 2% pay down yield. What that means is they actually borrowed money, equivalent to about 2% per our calculation. But they do have over here, they have a 4% dividend yield. And so basically to run the equation, you go, okay, I've got a 4% pay down yield, I've got a 19% buyback yield, that's 23, but I've got a negative 2% pay down yield, and so I wind up with roughly 21% shareholder yield. So that's, you can see how the equation works out, if you will. And so you can go down the list here and you can see the 25th stock actually is Symantec, and it has a 10% shareholder yield, almost all of which is, again, buyback yield. Comment on buybacks. We're at the part of the economic cycle where companies are finding themselves that their best investment late in a bull market tends to be their own stock. So that's amplified today because of the extremely low interest rates. They can go out there and borrow money to buy their own stocks back. So that's why you're seeing large buyback yields here. If you run it at different points in time, if you go to bear markets, for example, the absolute number in terms of shareholder yield and certainly the amount of stock that they're buying back changes radically. Next up. Okay, so this is the back test. This is, again, one of the features of Portfolio 1, 2, 3 I like the most. So, for example, 3 years ago or thereabouts, whenever I developed this screen, I had read Meb's book, I had seen all his charts, and I went, well, gosh, this seems like a good idea. Can I repeat this? Can I do it better than Meb did it, etc. And so I use backtesting to prove to myself that, yeah, this does work, and I might be able to come up with a better mousetrap, so to speak. Okay, so what is it that you're looking at? Up here, basically what I told the backtester to do is to take this screen and run it from January 2nd, 99 to November 8th of this year. Okay, so that's the time period we're looking at. I told it to rebalance once a year. So what that means is that effectively you buy a set of stocks based on the shareholder yield screen, and then a year later you sell them and you buy a new set of stocks. So that's what rebalancing means. I sometimes call that rotation, because rebalancing sometimes implies to people that you keep all the same stocks or ETFs or whatever, and you just make sure that you own them in the right proportion. But this is what they call it, so just wanted to explain that. So next thing up. Oh, by the way, I do the backtester set up to buy stocks basically on the open of the next day. So that basically says it's somewhat realistic. Next up, I'm going to skip down here to the chart before going through the statistics. Basically, this blue line that you see here, that's the S&P 500. Okay. So over this time period, I can tell you the S&P 500 made 73.4% in 17 years, almost 18 years. So, and that's because we had two very severe bear markets. Now, the red line is what the shareholder yield screen that we reviewed, what it has done. It made 702%. So it's not quite 10 times, but it's over 9 times the absolute amount of money. So that's pretty good. If you look at it from an annualized rate of return, what we call CRR or CAGR, S&P 500 made 3% a year. The shareholder yield screen made, call it 12.4. Now, the S&P 500, and this is in this period here, 2008, 2009, the financial crisis, the S&P 500 lost 57%. That was its max drawdown. This screen lost 70%. Okay, so it's more volatile and you would have lost more money. Now, as we've talked about in other segments of this talk, max drawdown is one of the reasons why buy and holders and other investors just can't take it. Very few people could take a 70% drawdown if they're aware of it, and so consequently, these are the sort of numbers that make people get out of their stocks and sell low and buy high. There are ways to control that with timing and volatility control, but that's another talk. We're just looking at what happens had you just run through the back test holding stocks all the time. Risk statistics. So here's the Sharpe ratio. Fred's talked about that. The Sharpe ratio of the screen is 0.59 versus the market is 0.19, so considerably more. The standard deviation, and you're comparing the standard deviation for an index of 500 stocks versus 25 stocks, so you're going to expect that the standard deviation is going to be higher, meaning that you're going to have a more volatile price difference on a daily, monthly basis. Standard deviation is basically what happens over the last year. In terms of the amount of variance you can expect. For the market, it's 19.4. For the shareholder yield, it's call it 21.7. That's actually for 25 stocks. That's actually reasonably good for a screen that is not trying to control for volatility. You've heard about beta and alpha. Beta being how much does the screen move, your stocks or your mutual fund or ETF move based on the market moving. That's 0.82. So that's, I won't say real low beta, but it's less than the market. And then the alpha, which is the extra value add that in this case, the screen provides, is over 10% a year. And that's, again, that's pretty good for a yearly screen. The other items I'll mention here just so you know what's going on. They have a panel here for turnover. You have to look real clearly. Every year there's a very light green line about how many stocks are turned over or sold and not rebought. That's usually pretty high. I'm eyeballing here, and I think the lowest number is 60% turnover, and in many years it certainly looks like it's very close to 100. And the last panel down here is the number of positions, and the number of positions is always 25. You can see that it just a gray block, if you will, because we're always buying 25 stocks every year, regardless of what's happening in the market. So all it says is, yeah, the screen is always 100% invested, no matter what's going on. Okay, next slide. So how do you run the screen? Again, this screen is run annually, so once a year you get an anniversary date to rerun the screen. I run mine on weekends. Some people I know run their screens on a date that's important to them. It really doesn't matter. If you're running a buy and hold type strategy, the question comes what happens with taxes. And that depends on what sort of account you're dealing with. So there's this funny little chart over here to the side where if you're dealing with this in an after-tax account, you've already paid money, taxes on the money going in that you're spending on the stocks. The growth you have to pay taxes on, and that's typically any dividends that come out or any capital gains that you have. But when you take the money out, it's all tax-free because you've paid all your taxes already. If you're in a normal IRA, not a Roth IRA, the money in is tax deferred, the growth is tax deferred, but you got to pay taxes on the way out. If you're in a Roth IRA, the money in is after tax, so you paid taxes. The growth is deferred, and when it's not taxed, and when you take the money out, it's not taxed. So that's those are the three situations you find yourself in. So if you have a taxable account where you are you have to pay taxes every year, so that would be a after-tax account situation. Basically, what a lot of people do is move. They run the screen, let's say a week before the anniversary date, and they make a determination. They can get a pretty good idea which stocks they're going to sell, and what they do is they sell stocks a few days early that are losses, and that gives them a short-term tax loss, and that helps them on their taxes. And they sell stocks that have a gain, shortly after a year, so they get a long-term tax capital gains treatment. So that's one of the games you can play. Now, over time, this may get messy, meaning that you might find, the dates from the end of the year, the 1 year period as you're using, the dates, if you do this long enough, continue to move further and further out to hold slightly less than a year, slightly more than a year. So from time to time, you may have to true things up and just not take the best tax advantage 1 year or another. But certainly you can typically run that for several, 5 or 10 years before that becomes a really major issue. Next up, there's lots of people that when they start talking about running screens and buying stocks this way, they're really hesitant. They're worried about it. I think I bought a lot. In this particular case, I got to buy 25 stocks. I got to do it once a year. How much money do I put in, etc. So first, my general advice to people is start off small and don't worry about this. There's nothing wrong if you want to do paper trading for a while, which is basically pretend you bought the stocks and see what happens. There's nothing wrong with paper trading. I equivalently do that myself many times to build up confidence or just see how certain things work. Uh, I know a lot of people are worried about commissions. Oh my God, if I only buy a few shares of stock, I only put in a few dollars, relatively speaking. The percentage of cost for commissions is very high. I don't worry about that. My viewpoint is if you're doing this as a confidence building measure, if you're doing it as a learning exercise, uh, when you put real money in, the commission, the percent of your cost from a commission viewpoint can drop. If when you're starting off and if you're somewhat hesitant, don't worry about the commissions. Just pay attention to how many dollars you put into the stock and how does that equity curve or how does that screen actually perform. Excuse me. There's actually some ways you can work to get the commissions down, and we'll be talking about those shortly. As a matter of fact, the next slide here talks about some of the problems and solutions. So, as I mentioned earlier, a major objective to screening is the number of trades you have to do per year. So, for example, in this case, I have a 25 stock screen. That means I have to do 50 trades a year. And where that comes from is at the end of the year, I have to sell 25 stocks and buy 25 new stocks. Now, if you try and time the market or if you try and do volatility control, that's going to add to your trade count. So assuming you do that once a year on average, which is not very frequent, you got another 50 trades, meaning if just taking a calendar year, if in June you think you need to get out of the market and then in July you need to get back in, well, that's another 50 trades. So now you're up to 100 trades a year. If you do that multiple times per year, you're up to possibly 100, 200 trades a year. So lots of people take a look at this and go, oh my God, this doesn't make sense for me. I got to spend a lot of time on it. I have to spend a lot of money on it in terms of trading costs. It doesn't make sense. There's ways to address this. You can find a low-cost brokerage so your commissions are low. You can negotiate fees with brokers. You can have wrap accounts where your trading costs may even be hidden from you. And there are also a couple of brokerages that are, if you will, are aimed at doing this sort of trading and make it very, very easy and relatively cheap. Okay, talking about those brokerages, the first one is Folio Investing. That's the one I use. They've been around a long time. What they offer is what's called window trades, where at 11 a.m. Eastern and 2 p.m. Eastern, they go in and they do block trades for everybody who made trades that day. So effectively you can put in a set of orders for example, to buy 25 stocks or sell 25 stocks, or actually do it at the same time, i.e. sell and buy. And it goes in and gets executed at, as I said, either 11 o'clock or 2 o'clock. That's what they call window trades. It's very easy to put in 25 stocks at a time. It's set up to do that. You can almost think about it as, trading a mutual fund as opposed to trading a stock or a set of stocks. Now, from another advantage of the way they do this is they buy fractional shares of stocks. So what that means is you go out and let's say you buy Apple. I can put 10 bucks into Apple. I think I've probably done something like that. Maybe not 10 bucks, but 20 or 30, something like that. And you will get 0.xxx shares of Apple. Okay, so you can buy fractional shares. Just like when you buy a mutual fund, you can buy fractional shares. You can buy fractional shares of stocks. So you can say, for example, in that 25 stock shareholder yield screen, I'm going to put 2,500 bucks into it. That says you're going to put 100 bucks per stock, regardless of the price of the stock, and you will get all all your dollars, all $100 will be invested. It's just that you're going to own fractional shares. Now, how much does all this cost? It's basically 290 bucks a year for all the trading you can swallow in terms of these folios. You can have up to 100 stocks per folio. I can tell you top of the head, and this is the sort of statistic that makes people think I'm crazy. I probably do 6,000 or 7,000 trades per year in my account at folio investing. Now, that sounds like a lot until you go, so this guy, has a 25 stock folio, and he has to trade it once a month. That's 50 stocks. That's somewhere around 600 trades a year just for one 25 stock screen. So you can think of it as 600 trades, or you can think about it as, he trades the equivalent of a mutual fund once a month. I may not be as crazy as it sounds. So in any case, this is why I often recommend to people that if you're interested in doing this sort of trading, or if you're a relatively heavy trader by other means, and your trading style fits Windows, folio investing is a wonderful place to go because essentially commissions are taken off the table. Another place, another brokerage, and this is a relatively new one that has the same sort of idea, is Motif Investing. In their particular situation, they will trade any time of the day. Either they don't do window trades per se, but what they will do is they will let you assemble a portfolio or a motif in their nomenclature of up to 30 stocks, ETFs, etc. And you enter the order. And so if you were doing shareholder yield screen there, once a year you'd go there and you'd enter your 25 stocks and you'd say buy, and they'd charge you 10 bucks for all 25 stocks. Roughly a year later you come back, you want to do it again, that's another 10 bucks. So if it's basically very lightweight trading. You can get in there with very small amounts of money. So, and your trading cost is, as I just said, 10 bucks. Obviously, there's a crossover point. If you're doing, let's say, 10 folios a month, 10 motifs a month, and you're trading every month, that's 100 bucks. That's 1,200 bucks a year. You're better off at folio investing. So you've got to think about what it is you want to do and how often you trade to figure out, should I be doing things in motif or should I be doing things in folio investing.